very nice that for anybody that was listening in on Kevin Prince's presentation from the BMO, it was nice that he mentioned I've known him for many years, and Kevin's a great guy, so very smart guy too. And I'm happy to say Kevin uses technical analysis, although that's his secret life that he won't talk about. Anyway, so today's presentation is on using technical analysis, and that's been my bag for. I've been in the business for 30 years, but probably 20 of those 30 years I've been focused on technical analysis. I was one of the original, I think it was 40 or so of us in Canada that got our CMTs. So I've been around the technical world for a little while, and I like to I do different levels of seminars and presentations, and I really like to simplify things when I don't know the audience. I do presentations for the Canadian Society Technical Analyst Group sometimes, and I'll ramp it up a bit. But really, the problem with being too complicated, if you want to call it that, people can get in all the little squiggly lines, so to speak, on technicals, use all these comparative analysis things, etc., which I like to do. But the problem is that you can almost lose sight of the forest for the trees, as they say. So what I want to do is concentrate today on let's look at some of the past bear markets. Now, we'll talk about whether this maybe is a bear market or if it's just a consolidation, but we'll talk about that in a minute. I have a way of defining bear markets, but we'll then talk about past bear markets and how they played out. And in fact, a few people I think that are listening in today will be readers of my blog. I have a blog called the Smart Bounce blog. You can find it at our website at valuetrend.ca, and you can follow us on Twitter. All this stuff will be at the end of the presentation, but it's a non-commercial blog, I guess you could say. It doesn't. It's an educational blog. We don't promote our company so much on it. It's really just a discussion group for people interested in technical analysis. But so I will. Some people will be sort of familiar with some of the stuff that I'm going to talk about here, but I wrote a blog the other day called The Plan. It was a little bit jumbled because I had a lot to talk about, but it's going to this seminar is going to cover the basics of what we spoke about on the blog. So let's get into the main thrust of it. This is a disclaimer. You guys have seen them before. Basically, I will disclose on any of the stocks. We're going to talk about some stocks today, but we'll also talk about the markets, and I'll disclose when I own them. But none of this is investment advice. In fact, really, you have to, whenever you look at any one type of analysis, like I'm going to talk about technicals, but I have a CFA working with me, and we look at the fundamentals, and I won't be addressing the fundamentals today. So you need to have both sides. One of the issues facing anybody that's been to a presentation of mine, I always present this slide. It's kind of I always talk about market timing. The problem that technical people are sometimes pinned with this idea that we're market timers, and we're not. Really, if anybody goes to my blog today, it was yesterday, I wrote it on something called the barometer, and I look at a number of different factors and try to determine risk on the market. It's got nothing to do with knowing the future. It's trying to measure risk versus return. And really, that's any type of analysis. So I just want to suggest that this is not about market timing. This is just always about weighing the odds, okay? So this is basic stuff, and some of you that study technicals will understand this. Don't worry, we're going to go a little deeper down the rabbit hole, but I don't know my audience here. I don't know how sophisticated people are. So we're going to just define, and this is important because you've got to get back to the basics sometimes. This is the definition of a downtrend is, this isn't rocket surgery, lower peaks, lower troughs, okay? Definition of an uptrend is the opposite. And when you're making similar peaks and troughs, you're not making any new higher highs and higher lows. You're in what's called a consolidation. So that would be this zone in here. And that could be a top consolidation or a bottom, okay? So again, there's the definition. I also will add in that a confirmation of an uptrend is if the market is above the 200-day simple moving average, is what SMA stands for, and if the confirmation of a downtrend is below the simple moving average. Okay, so within the context of understanding that is what a trend is, lows and highs, what are they doing? I look at a weekly chart for my time horizon. Some of you might look at dailies. I'm going to suggest that there are 4 phases, and this again isn't rocket surgery. There is a a tendency for markets to move between consolidations, whether it's a bottom consolidation or a top consolidation. And how you tell when you're in a consolidation versus an up or down trend, like I mentioned before, is no more highs and lows. They're taking each other out. So this is it's called, I'm saying a 30-week. We really should say 40-week moving average. That's the 200 days, roughly 40 weeks. But you'll notice a tendency is that when markets are consolidating, these market moves around the moving average. So the moving average is kind of useless during a consolidation phase. But you can definitely define that the trend is in place when it's above or the market is below that moving average. Okay, so I just want to define that because we'll be talking about that right now. And so let's just take a look here. I'm just going to try to. I have. Oh, there we go. I'm going to take a look at Google, a company that maybe a few of you might have heard of. They but the market definitely does seem to be struggling with a little bit of a consolidation right now. Google's outperformed most of the stocks on the S&P 500 right now. We own some, by the way, I should disclose. But it's definitely not as easily defined as an uptrend. But it's a good tool to use. Is this moving average with higher highs and higher lows. So we use that to define the phase. So I mentioned that there's 4 phases, really top consolidations and bottom consolidations. You can see when the market stops making higher highs and higher lows, like it was here, and moves below the moving average, you move into a different phase. And same here. You had lower highs and lower lows, and it was below the moving average. Then, boom, it moved above the moving average, and there's the last high. It was taken out. That kind of defined a new uptrend, and so on it goes. You'll notice that this is a monthly chart, so that's a 10-month moving average, which is the same as the 40-week, which is the same as the 200-day, roughly. So you'll notice that the market is below its 200-day / 10-month moving average right now. The question I have right now is, and we'll talk about this as we go on, but on the monthly chart, you'll notice that the lows are roughly even. So it may not be a true bear market that we're in right now. However, you can see that spike there was the weekly low. That would have been March 23rd. That took out the low there. So it's arguable as to whether we're in a beginning of a longer term bear market. But because we're below the moving average, the 200-day moving average, I'm going to kind of consider that it is at least in a dangerous position. So this is a weekly chart, and unlike the one we just looked at, where it kind of looks like dead even lows, you can see that the weekly definitely took out the weekly of December of 2018. Okay, and like I said, it is below the moving average. So for my purposes, I have to treat this like a bear market, at least the potential of a bear market for the time being, despite the monthly chart. Okay, now if it moves above the 200-day, then maybe we can change our mind. So you'll notice here, most of the time this works. So there's a low, it was higher, even though it broke the moving average, you didn't have to sell higher, low. Here you got faked out, okay? High, there's a low, there's a high, there's a low that was lower, there's a high that was a little bit lower, and there's another low that was lower. So, we actually did get faked out in early 16, and then it moved on up, so we had to rebuy because we sold. But it most of the time works. You can see the buy and sell signals, and they're pretty good. They don't get you out at the very top. They don't get you in at the very bottom. But that's magic. We're not magic. We're trend followers. So if we look at historic periods of bear markets, and again, it's debatable whether we're in a bear market, but on the weekly chart, I'm going to say we are in one, at least some evidence. If we look at bear market of the bull market that led into the 2000 tech bubble crash, you can see that we moved below the 200-day moving average, which is the red line here, and we started making lower highs, lower lows, and we broke this trend line. Okay. One of the tendencies of bear markets is that in their retracements, you tend to get about 50% retracement, and this doesn't happen constantly, but if you measured this is about 1,500. The low was about 1,060 or so, and then it retraced to about almost 1,300. That's almost 50%. That would have been about 40-odd%. This sell-off was definitely a 50% retracement before it moved down again. So what we're looking for is that we want to see the market break the 200-day, but you can see they often, the market will come up to the 200-day moving average and then fail. Okay, during a bear market, here it is again. It briefly blew through it there, but then failed pretty quickly. So you need to have a system where you don't just move just because it moved above the moving average. You need to see that last high taken out, and you want to see a number of days, if not weeks, that it stays above the moving average so you don't get head faked. Okay, but for comparison, just to look at that bear, you can see there was a series, and there was an initial sell-off followed by a rally. Okay, let's look at 2008, 2009, same thing, an initial sell-off followed by a rally. Now, I must say, back in this era, I was probably only 10 years in the business at this point, and I just got clobbered and followed along with the crowd and lost money. I had began studying technical analysis around that period, but I was a pretty lousy technical guy. By 2008, I had learned a few lessons, and so during this rally, like we wanted to see if it would break the moving average and move on, and it didn't. So we started selling, in the early part of the summer of 2008, and we did it in legs. We didn't just sell all at once, but it saved us a lot of grief. I posted my performance for that period a while ago, just saying that, hey, if you lose less and you're holding cash, then when it finally meets your buy rule, where it breaks through the moving average on the upside, and the last high is taken out, and the last low is higher as well. We started buying in more or less July, August of 2009. We had cash to do it. We saved some grief on the way down, not all of it. So you got to have a system to prepare. Now, had the market taken out the moving average, I would have gone back in after a count of a few days, but it didn't. So that's how we kind of saved our bacon in 2008. Right now, here we are. So you can see there was a big parabolic move on the market, which suggested that the market would sell off. We got one of those in 2018, leading into the November, and then by December the market had troughed pretty hard. So that can happen. That was a move below the moving average, and it kept us out of the market at that point. But eventually retrace. So again, it's important to study to make sure that you do break above that moving average before you can confirm a new bull. Right now we're below that, and you can see we are struggling. We'll look at it closer a little bit later, but we are struggling with at about 2,900 or so. It had a nice run. There's the 23rd of March, and then a nice run up of that. I mentioned the 50% retracement. We had about a 62% retracement, which is a Fibonacci retracement for those people that like that sort of stuff. That's another common retracement, and that was as of last Friday, and it's struggling now to get through that 2,900 or so that it hit last Friday. So maybe it could make it to the 200-day. You've seen that in the past bear markets I just showed you. It often hits the 200-day moving average and fails. So I'm in cash right now, and we have like 36% cash right now. So if I'm wrong, and I miss out on, because we were selling through here. If I'm wrong, the market goes higher, fine, I'll buy higher, and I missed out on maybe 5 or 10% upside. But I would rather be that than go through another one of these years, So that's what we did in 2008. Actually, we avoided a lot of this, where we didn't avoid any of it in 2001. But I did learn my lesson, so that's the way I'm playing it right now. Okay, so if I had a live audience that would be able to put up their hands, and I'd call it, what phase was this on? This is Boeing, and you'd say consolidation. You could see it's kind of going sideways. There's an uptrend. There's another consolidation, and son of a gun, there is a breakdown. And so what phase are we in right now? Well, it's definitely been in a bear, and it's attempting to consolidate again. Okay, would you buy it? I would usually ask you, and in a live presentation, and you would say no. I hope, because it's not finished consolidating, and it hasn't really shown any evidence. This is the CRB index. It was consolidating forever, and then fell out of bed with the COVID crash. Same thing. It's nowhere near consolidating though. Whereas like Boeing, at least is it's made the low, and it's kind of moving a little bit sideways. This thing is still in kind of free fall. So I want to, that's just a couple of examples. Now we're going to look at some stocks right now, and we want to look at examples of current stuff that you want to consider, and how to trade within this market. So one way to trade is within a long-term uptrend, and this is one stock that we recently got out of, but we had been in the stock and made some money, fairly good money on it. CGI Group, Canadian company. You can see higher highs, higher lows forever, usually above the moving average, never really taking out any lows or anything, so we never broke our, violated our sell rules. Recently, it's funny, it started to round over, it broke its moving average, and we, before the COVID thing, we were just looking for, kind of an exit around here. Boom, but it retraced, and that was one of the stocks we sold recently, because the longer term trend broke, and it's still well below its moving average. So we didn't get out, perfectly on it, but we just literally sold it about 2 weeks ago. And the point is that I don't want back in yet because the trend is broken. Okay. Now it's great to buy a stock that's in an uptrend, though. So here's an example of an uptrending security. This is the 30-year U.S. Treasury bond. Now it's in a trend channel. It's a very defined trend channel. I won't talk about all the squiggly lines too much today, but this is rate of change. And you can see that, sometimes when the rate of change gets to a certain level, it coincides with the bottom of the channel, and it can provide a buy signal. And same with the upper ranges, the rate of change gets to the upper levels and sometimes, signals a sell within that channel. We're kind of there right now. As you can see, the 30-year bond is at the top of its channel. So short-term traders would maybe consider selling the 30-year bond and rebuying it later. Okay. But long-term investors could own the 30-year bond at this point and probably, putting up with swings of 10 and 20%, but, you would net so far, you would be on trend. If this breaks, then you've got a different situation. This is a range-bound stock. This is the yen currency. So traders that want to trade the yen, would try to buy. You can have great opportunities in this kind of market for this kind of trade. So buy a yen ETF or something, and when the yen reaches somewhere around 84 per US dollar, and sell it pretty much where as it's getting closer to the sell point, closer to 90 to 91. It's at 88, 90 right now, so let's call it 89. So that's close to the top. You wouldn't buy the yen in a range-bound market. But sometimes range-bound markets are taken out. So this is Stantec, and some of you might be familiar from the Canadian side that are listening to me. I've traded this stock many times in this range. In fact, I think we traded it 2 or 3 times. Then it broke out recently, and funny enough, the COVID crash brought it right down to the top. That often does act as support. The old resistance becomes new support, and sure enough, it's bounced off of that. So this one, if it did, let's say the market does decide to do a mark down again over the next month or two, which is my opinion, but nobody knows. But if it does, you might see Stantec get close to $35, $36 or so, and that might be a great point to re-enter because it's broken out of this consolidation. Maybe it's going to enter into a new kind of range between 35 to 40. So that's just a question, but often when these range-bound stocks break out, they actually end up in an uptrend. So there's just be aware, if a stock breaks a long-term range, it's actually pretty bullish. Here is the long-term range of the commodity index, and you can see, boom, it broke down. Okay, so that's a bad thing, although it may be consolidating really early, hard to say. And the problem is this is a broad commodity index, so it's an ETF. I have traded this before. I used to trade this. I traded it once within this pattern, and we did okay on it. But now it's broken down. Okay. This is General Electric. Now, General Electric, we owned it, and we actually own it again in one of our platforms. But I'll give you the logic. We owned it in our conservative equity platform where it was in an uptrend. You could see how it was in an uptrend, and then it broke the moving average. Then it broke its last low here, which I drew a line here for, and the red is where we sold. Okay, we don't know exactly where to sell it, but you wait a few days to see if the break is going to take. You don't just say, okay, it broke, I'm selling today. You wait. My rule of thumb is 3 days and up to 3 weeks. So you don't want to be head faked. So anyways, that's where we sold GE. Now, it's consolidating. Clearly, it's consolidating, and you can see the support comes in around $6. So we do not own it right now in our conservative equity platform. It would be pretty crazy for us to do that. But we have one called our aggressive strategy, and we trade swings. And it looks like it's a swing trader. It may not be. It might fail. If it breaks $6, I'm out. But it's probably a potential move of a couple of bucks from an oversold position. But if it breaks, I know exactly where I'm going to sell it. I'm going to sell it below $6. So we bought that in our aggressive portfolio, not to be confused with our conservative model. Okay, so there are different ways to trade stocks in any environment, depending on your personality, I guess. This is Europe. We did own this a while ago. We decided to raise cash, as I said, because we were looking for positions to sell out on the recent rally after the 50% rally. So this is one of the things we sold. You can see it's consolidating, and I would actually buy it if it broke out again. But we kind of watched it fall, watched it move up to here, and sold it, and it really hasn't done anything since we sold it. So we're not unhappy, even though we took a bit of a loss on it. This is Heinz, Kraft Heinz. This stock was, you could go back in history because I have a huge chart that goes back on this. It was one of these like General Electric. It was going up, making higher highs, higher lows. It would consolidate, broke the moving average, started making lower highs, lower lows. The signal was clear, get out. Now it appears to be basing. We don't own it. But I would consider buying it if it broke 32 and a half. Okay. But it's nowhere near that right now. It just keeps on failing at around 32 and a half. So that's why a trader could make money. You could trade it, possibly for oversold bounces like it tends to do. But a longer term investor should probably avoid Kraft for the time being. Okay. If it breaks 32 and a half, that's a whole different story. Tech. Now we bought this in our aggressive platform recently. Okay, again, not our conservative platform. There is some argument on the fundamental side that with all this money going in from the Fed, that it'll create inflation eventually, and commodity-based stocks will do okay. I have a CFA named Craig Coyne who works with me, a fellow portfolio manager, and he thinks it's a pretty good bet, if that happens. So this is our choice. We haven't bought it in our conservative platform, meaning that it's probably not a conservative investors type of stock. But if this little movement, which does seem to be trending up on the daily, on the short-term move, if it were to break around 13, it would actually be quite bullish. You'd probably target the 200-day moving averages versus resistance, which is not a bad return. So we may buy it in the equity platform, but right now we just own it in our aggressive platform. Okay. Now this is one we do own in the conservative platform, and I think we own it in the aggressive one too. Now we bought it here, and it went, but we decided to hold it because we'd looked at a bunch of things. First of all, it pays a pretty sustainable high dividend. But the other thing interesting is that after I watched, there's the crash, and then you watch it for a bit because it's too late to, you're already in it and you already watched it fall. So now you wait for a consolidation and you see if it's going to break out, and it did. So we decided to hold this stock, and I think it has a potential for maybe getting into that $40 range. I don't think a lot of stocks are going to return to their old highs, but I think $40. Well, they may someday, but I mean in the next, say, number of months. So I do think that this thing could get to the high 30s, and it's got this crazy high dividend, and it is sustainable according to Craig. So at least for the time being. So I disclose we own that, and you have to do your own fundamentals. So that's not an investment advice, by the way. Walmart, we just bought this today. Why? Using the rules, higher highs, higher lows. It consolidated. It broke out. That's considered very bullish. I love buying stocks on a breakout when it pulls back to the neckline. So boom, it came right back. We bought today. So we're in on a first leg. We often buy in a couple of different tranches. So that was Walmart. So that's it for I threw a lot of ideas at you, and so what I wanted to do was just give you an idea of where I think the market's going, which I think so long as it stays below the 200-day moving average, it's got more potential for another leg down, although not necessarily lower. In fact, I don't think it will. But the second thing is that within this market, maybe how do you trade? And I think technical analysis allows you to use some rules to look for those kind of things that we were just talking about. So I tried to give myself lots of time for questions. So if there are any questions, please let me know, and Mark can come on and fire the questions my way.
All right, thank you so much for that presentation. We do have some questions rolling in. First question, what moving average would you reference during this time?
Well, again, I'm going to use for the long-term investor. I'm keen on that 200-day moving average, like I was mentioning. However, if you are a trader, then obviously you're going to shorten that moving average, and it's also according to the pattern. So if we go back to this pattern, then it's an uptrend. Then we have probably pay attention to that 200-day. If we go back to consolidation type of pattern like this, if we go, so it was the long treasury we already looked at. So I think it's in a trend channel. It's at the top of the trend channel. So like I mentioned on the slide presentation, it's probably going to have a pullback in the next little while. Okay, but it's the long term. It's made money over the long run, so it's in a long term uptrend. But I think it's likely to pull back in the near term just based on where it is on the trend channel. But XGD is a gold, and that's really been the the hot topic lately. Oops, didn't type it in right. It's xgd.to. Should work. There we go. Okay, so clearly the sector has broken out. Okay, it was the dog's breakfast for quite a few years, and it's broken out. It's above the moving average. It's pretty parabolic, as you can see. If we applied, and I don't want to get too down the down the rabbit hole here, but with all these squiggly lines. But if we started looking at oscillators, you'd see it's overbought, right? And that's because of all these white candles. It's good. There's the relative strength study. It's outperformed the market. And it may just pull back. You could find there's the old breakout point, and it could pull back into the $18 to $19 area because it's so darn overbought. You can see that on stochastics. This is a daily chart, RSI, but that's more of a short-term call. I think that the fact that it's broken out is very, very bullish. So, okay. So next question.
All right, thank you. Looks like we have about a minute and a half remaining here. Someone was questioning, where do you think Shopify is going?
Oh my gosh, yeah. I bet you that's never been asked at your show today by any of the speakers. Yeah, it's on fire, and there's, you can't argue with these breakouts. The only thing I've noticed is, like I mentioned with Walmart, like why we buy it, because I love breakouts, but you buy on the pullback. Hey, it could keep going. It could be parabolic. It could go and go and go. But look. Moving averages, the momentum stuff is starting to tell us it's overbought. There's stochastics, it looks kind of rounding over like it has before. That tends to coincide with pullbacks. RSI starting to get a bit overbought, not as bad as here. So all these factors, there's MACD high. So I'd say short-term pullback, but bigger picture is good.
All right. Cindy was wondering, do you look at just charts, or do you take into consideration the economic conditions as well as the charts?
We're not economists, but we definitely take into consideration fundamentals. I have Craig Gacoin, who works with me. He's a portfolio manager as well in our shop, and he's a CFA. I'm CMT, so we look at both. So as far as the economy goes, the stock market's really a leading indicator to the economy. It's supposed to be. Sometimes it guesses wrong, so you got to be careful with that. So we don't We do, but we don't. We're more into the charts and the fundamentals of the individual positions that we look at. But the macro, look at my blog today, valuetrend.ca, and you'll see one on barometer, and that does take into consideration a lot of different factors to make a risk judgment, a risk reward judgment. So, can we fit one more in, or are we done?
Yeah, we can get one more in. They're wondering about Canadian banks.
Oh man. Yeah. Again, this is like I look. I'm a technical guy, and I mean, you could buy them maybe for the dividend, but this has been no man's land for a while. And in fact, I'll clean no grid. There we go. You can see that there was a lid before. Like, I have been out of the Canadian banks for a while. Now, we do have a little bit of that BMO ZMT in our income platform, I might have mentioned, because it pays higher dividend because they write calls against the banks. But as far as, and it's a small position, as far as the pattern is still kind of crummy. I mean, it was consolidating and then it broke out of it. It's now testing old support, which becomes new resistance. Fundamentally, how's the business going to look over the next couple of years? Probably pretty lousy. I wouldn't necessarily buy them for an equity play, maybe for a dividend play.
All right, that looks like that puts us at about time. We thank you so much for being here. We hope we get to see you in Toronto.
Yeah. I've actually talked to you guys about that, so I think I'll be doing it. I usually do the Orlando show as well, so I always look forward to doing that one because there's palm trees. So you will see me in Toronto. I'm encouraging everybody to read the blog, and it's free and it's not a commercial. It's not an infomercial, so to speak. It's a technical chat site. So I really enjoy having new readers and their comments and stuff like that. Okay.